Okay, so let's go back up to the discussion. We're going to be looking at some of the robustness tests. And so first it looks like we're going to analyze the impact of transaction costs. And so we note since there are 12 months and they are rebalancing the portfolio every month, the maximum turnover percentage would be 2,400%. And that would be as if every position was exchanged each month. It looks like Exhibit 8 has the analysis of the turnover, and it varies from 200% to 1,600% for the 1 month strategy. So let's go down to Exhibit 8. Yeah, okay, so we have the 1 month strategy here, the 12-1 strategy, the valuation strategy, and the combined strategy. It looks like the 1 month strategy is the highest turnover, and the value strategy is the lowest turnover. But the combined strategy, even after transaction costs, has the highest net return. Well, I suppose it depends on the level of transaction costs. So looks like at 0.10%, it's still the highest, and 0.25% is still the highest. But at 0.5% transaction costs, it's going to be just under the valuation strategy, which had the lowest turnover. And so we note with the combined strategy, even though at a transaction cost of 0.5%, the valuation strategy beats it net of costs, we still have a significant outperformance here of almost 5%. So let's go back up to the discussion here for the next robustness test. So it looks like they're going to do an out-of-sample test where they're going to look at the period January 74 to January 86. I think the period that what they used before was 85 to 2007. So we're going to see what the results would have been during this pre-sample period. And unfortunately, there wasn't any data for emerging market equities, high-yield bonds in the U.S., German bonds, or Japanese government bonds. So there's only 8 asset classes that they can use during this period. And so because of that, it looks like each quartile is only going to have 2 asset classes. So that would be 4 quartiles with 2 asset classes each to get us a total of 8 asset classes. And so they're going to use the same strategy that they used before, only doing it in this pre-sample period, and the results are in Exhibit 9. So let's go down to Exhibit 9 and see how this strategy turned out. And so this table is similar to one that we saw before, with Q1 having the top portfolio ranks and Q4 having the bottom portfolio ranks. And we can see the top portfolio performs the best relative to the bottom portfolio, and we can see that difference here in the outperformance part. And still the combined strategy still seems to outperform all of the other ones individually, and that's both at a nominal return as well as the risk-adjusted return, which is detailed down here in the information ratio, which is 0.69 compared to 0.46 for value, and then the momentum strategies don't perform as well as the value. So anyway, we have a similar result to the end sample period that we tested before, which was the 1985 to 2007 period, where the combination strategy performs better on both the nominal and the risk-adjusted basis. and the top ranked portfolios, according to our ranking system, performed better than the bottom ranking portfolios. And in most cases, monotonic increase almost. There's differences here where it's not exactly monotonic, but it's somewhat of an upward sloping result. Okay, so let's go back to the discussion. I think we have another robustness test to analyze. Yep, so we have a third robustness test. So it looks like we're going to look at the effects of using asset classes returns. They're adjusted for their volatility. So they make note that, of course, some asset classes are more volatile than others, so that may sway the ranking system to where in an equal weighted portfolio, some of the assets may be dominated with positions in more volatile assets, such as emerging market equities. And also of importance, since the volatile assets are more likely to be in the extreme ranked portfolios, especially in momentum, for instance, where the past returns are likely to be either really high or really low compared to other asset classes, they'll tend to be in the more extreme quartiles. And so the authors are going to make some adjustments to make these volatility characteristics more even across all the asset classes. So it looks like they, at the beginning of every month, they look at the annualized volatility over the past 60 months, and they either increase or decrease the weight in that position to get it to a target volatility of 10%. So they have an example here. For instance, if the trailing volatility for the emerging market equities was 20%, and the U.S. Treasury's volatility was only 5%, they're going to try to bring these volatilities to 10% each. So that would mean cutting the weight of emerging market equities in half to get to 10% volatility, and to double the weight of the U.S. Treasuries to get their volatility at 10% also. So Exhibit 10 has the results of this. So let's go down here to Exhibit 10 and see how this strategy worked out. So it looks like we've still got some strong results here where the Q1 outperformance is significantly more than the Q4. Here we have some really significant T statistics as well, so that's good. The returns seem to be way more monotonic than what we've seen before. Actually, every one of them is an increasingly monotonic return, as well as the Sharpe ratios. And as been found in the other strategies, the combined strategy seems to outperform on both the nominal and the risk-adjusted basis, with a very high T statistic as well. Okay, so let's go back up to the discussion for our final robustness test. And that is, there may be a concern that the returns of the strategy might be driven by just a few asset classes. However, it looks like this strategy passes that test as well, and the results are in Exhibit 11. So let's go down to Exhibit 11 and see how diversified the returns were. So this is the returns of or it's the average monthly returns of the combined strategy, and it shows the returns of each of the asset classes when they're ranked in the different quartiles. So we can see here, at least with the first quartiles, to be the top ranked securities whenever these asset classes are ranked in that quartile. they always have an average return greater than 0.3%. And on average, that return is about 0.8% across all the asset classes. Also interesting to see in the bottom ranked quartile is Q4, the returns are in each of the asset classes is less than 0.2%, with the exception of the U.S. mid-cap equity, it looks like. And so from this, even just looking at this, we can see that the returns of these strategy aren't just isolated to a single asset classes. The returns are kind of spread across all of the asset classes. So let's go back up here. I believe that was the last robustness test. Yes, so now we have a little bit of discussion. And so here in this discussion, they want to discuss some of the explanations for why the momentum evaluation strategies are so effective. And they make note that, yeah, their findings could possibly just be due to data mining or chance. And if that were the case, these relationships and returns would certainly break down in the future, and there would be no alpha opportunity left. But in their opinion, that's not likely to be the case, and this strategy should show similar results going forward into the future due to the statistical significance of the results and also the basicness of the strategy. Another possibility is that they're not properly adjusting the returns for risk, and by that they mean that their strategy may just be selecting high or low risk securities, and with high or low risk, then those securities will earn a high or low return. So then the returns are just compensation for risk and not necessarily an alpha or some kind of anomaly that gives them the excess return. And again, their opinion is that explanation is likely to not be true. And in order for that compensation of risk to be a valid theory, then it would be really tough because the return spread was about 12% that we saw in the tables before. So that's a pretty high hurdle to have to make, and that would actually be a lot of risk too. And they note that in fact the results are so strong that the bottom quartile portfolios, that was the ones that were Q4, find excess returns close to zero or even negative, while the time varying risk premiums all remain positive at all times. And also there doesn't really seem to be an increase of risk for the or return for the top quartile portfolio assets versus the low return bottom quartile portfolio, and we would be able to see this in the tables with volatility or skewness or other statistics that aren't reported in this paper. So for some added assurance with regard to this, they have Exhibit 12, which kind of compares the returns across different regimes, for instance at different VIX levels, term spread levels, credit spread, interest rate levels. And so let's go down to Exhibit 12 and see how these strategies panned out in the different regimes. So here we have each of the strategies and different regimes. The VIX tells you how volatile the market is, and so low VIX would mean low volatility regime, and a high VIX would mean a high volatility regime. So it looks like here the combined strategy still outperforms the other strategies, and in fact the combined strategy outperforms across all kinds of different macroeconomic variables. Although in a high interest rate environment, combined strategy doesn't do as well as the 12-1. So what the authors are trying to prove out here is that the return for each of these strategies would not be very much different no matter which regime the market is in. And so that seems to kind of be the case where for each of the strategies the return is about or pretty much the same in each of the regimes. For instance, here with the VIX, the return is certainly higher in a low VIX environment, but it's pretty close to the high VIX environment as well. There are some discrepancies, however. For instance, with the valuation strategy, when credit spreads are high, the valuation strategy performs better, and that kind of makes sense because the credit spread is basically the spread between the yields of high-risk bonds minus the yield of low-risk bonds. And so in a high-risk environment like that, which would be indicative of a high spread, then there will be a lot of cheap stocks most likely, and or cheap securities that the valuation strategy would pick up on at deep discounts. And it looks like the opposite is true of the interest rate regime, where a low interest rate regime is good for the valuation strategy, and a high interest rate regime is bad, or not as good. But it seems like the other returns kind of fall in line, although the interest rates are pretty indicative of the different strategies. For instance, the 1 month momentum return is double that in a low regime than a high interest rate regime. So anyway, it appears that overall the differing regimes don't particularly dictate the returns of the strategies. So let's go back up to some more of the discussion. And so they note that the findings where these strategies outperform really challenge the concept of market efficiency. But they do note that it's kind of difficult to quantify the risk-adjusted returns here because each of the asset classes risk is somewhat defined and calculated differently, so it's really tough to have an overall risk calculation to see whether the returns are actually being compensated for risk and therefore the market is efficient, or is there actually an anomaly here? So they do note that the momentum and value effects that they use are found here across asset classes are similar to prior studies that looked at individual securities within those asset classes. And a lot of behavioral theories have been put forward for that, especially with the momentum anomaly. And so they note that since these effects are occurring across the asset classes, as we found in this study, maybe these behavioral effects are also carrying over into the asset classes and creating a market inefficiency there. And they note that this might be caused by too little smart money available to arbitrage those inefficiencies away. They've got a couple of reasons to support this hypothesis. The first might be that a lot of investors would shy away from aggressive tactical cross-asset allocation because they might perceive it to be too challenging. And so the authors note that certainly the approach that they've used here is very basic and simplistic, and there's no real certainty around the valuations of the asset classes, so that makes it somewhat difficult. And also, if you think about it, each of these asset classes really shouldn't be valued according to the way that they did. For instance, simple yield measures or so on and so forth. those asset classes obviously are a lot more complex than the process that they've used here. So the next reason is that professional market participants usually specialize within a particular asset class and select individual securities within that asset class. For example, if you're a high yield bond manager, you're going to be more concerned with selecting the best high yield bond securities within that asset class and not really worried about how is the asset class as a whole going to perform. And so as a result of that, allocation decisions across asset classes tend to be done by the end investors, and those would be, for instance, pension fund boards who authorize their allocation mandates, or maybe individual investors. And this is due to a lot of different reasons. For instance, long-term considerations. And for example, with the pension funds, then they may have an asset liability management where they need to allocate their assets in a certain way to be able to meet the liabilities that they have for the pensioners in the future. And this also flows through to schemes, for instance, 401k, where there's a fixed allocation mechanism. So where inflows of cash may be automatically directed to different asset classes as dictated by the owner. They also have herding behavior too, where they don't want to deviate from a peer group. And also some of the more momentum effects, for instance, recent performance may have persuade people to put money into the past winners and get out of the past losers. So they note that due to all of these constraints, it doesn't really seem like going forward any of the returns that we've seen in this study so far would be arbitraged away. It seems like they would continue to go forward because each of these different motivators and allocation aren't going to go away. So then the effects of these strategies probably won't go away as either. So the authors note that really one of the only types of investors that would be able to arbitrage away the excess profits from this strategy may be hedge funds, where they try to capture that alpha. And so what they've done here in Exhibit 13 is try to regress the returns of this strategy against the returns of hedge funds and see if there's somewhat of a correlation. So let's go down to Exhibit 13. So it looks like they are going to have a hedge fund index here that they're going to compare against the Q1 minus the Q4 strategy. So that would be as if going long the Q1 and going short the Q4 portfolios over the 94 to 2007 period. So it looks like all of these right here, T statistics. So the ones that are bold would be significant, and that would mean that we could conclude that this particular factor is not 0. And so it's likely that there's a positive relation of this factor to the returns of the hedge funds. And so it looks like this right here, we have a multiple regression where we're including or we're regressing the returns of the 1 month, 12 month, and the valuation strategy. And then we have a single factor regression here, which is just the combined strategy. And only the bold ones are the ones that are statistically significant. And so we have that here, 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 and here, at least with the multiple regression. So in that regard, we could say that the 12-1 strategy looks like it has the most, or it looks like it's positively related to the most different hedge fund strategies. Hedge funds overall, it has a positive, statistically significant relation. So maybe a lot of hedge funds on average are using this 12-1 strategy. The global macro, long, short equity, managed futures, and multi-strategies the returns seem to be positively related to the 12-1 strategy. Let's look at the combined strategy here. It looks like the managed futures and the multi-strategy are the only ones that seem to have a positive relationship with the combined strategy. And so we could say that some of these hedge fund styles may be using somewhat of the momentum or valuation strategies in their portfolios, but for the most part, overall, it doesn't seem like there's much of a relationship between the strategies and the hedge funds. So maybe it's not being used as prevalently as would be required for these results to be arbitraged away. So it's more evidence that maybe this strategy will continue to earn excess returns. So let's go back up to the discussion. I think that's the end of this section. Yes, so now we have summary, implications, and extensions. So here we will summarize everything we found in this paper. The first thing, the 1-month momentum strategy and the 12-1 month strategy and the value strategy all gave us significant return premiums of 7 to 8% over the 86 to 2007 period. And then when we combined each of these individual strategies together, we got an alpha of 12%. And so this is really useful not only for practitioners, but also it kind of proves out what has been found previously within asset classes where there have been momentum and value effects, for instance, with individual stocks or something. But here they found that this actually occurs across entire asset classes as well. And even after adjusting for the common Fama French and Carhart factors, the 4-factor model, there's still significant risk-adjusted returns, and the alpha is still significant. And this certainly provides a challenge to market efficiency because we weren't able to explain those excess returns with risk factors. And we had several arguments against these risk-based explanations. And for instance, the financial markets may be macro inefficient because there's not enough smart money to arbitrage away the mispricing effects that arise due to behavioral effects that we listed out in the previous section. And the authors note that the hedge funds may be the most likely candidates to arbitrage away those mispricings, or those alphas, but that doesn't seem to be occurring when we looked at the regressions of the strategy's returns relative to the returns of the hedge funds. So here they suggest a lot of different ways that future researchers could extend the studies here. They suggest that maybe other researchers could expand the number of asset classes that are covered by the strategy. Another way to extend the research would be to analyze different predictor variables. For instance, here they used, yield variables, and this could even be expanded to be, for instance, time period or winter-summer effects, or macroeconomic indicators such as the consumer producer confidence, interest rate changes, oil price movements, so on and so forth. So really, there could be a wide range of different indicators to rank the different securities with. The third thing that future researchers might could do is to introduce some kind of portfolio optimization in order to improve the risk-adjusted returns. And that would be welcome because this ranking system here kind of ignores correlations between assets and kind of makes the portfolios, or maybe they end up being suboptimal, and someone else would be able to optimize these rankings.